All right. You should be able to see the screen. I sent you a few crash course notes. We're going to go through the first four topics this week, and then in 2 weeks' time, when we have the second session, I'm going to spend another 2 hours going through the next four topics. After that session, or maybe before that session, I think I will send you a past paper pack just in terms of what I have from previous years in terms of content, and that might help you in terms of questions and answers that you can maybe use in preparation for your assessment. Are they still going with online, or have they changed it now? Do you have to go to an exam venue and write a written assessment, or are you still completing everything on the portal, the UNISA portal?
Yes, so everything is still online.
Okay, that's good. So hopefully that'll help in terms of like preparation and approach, and having access to your templates. So use the examples that you have in the textbook. The textbook is actually very good. In the past, there were some problems with FIN3701. That's the one that you did last time. Um,
Yes.
I think they've improved the module quite a bit, so that's good. This module hasn't been problematic in the past, but as I said, always reference the textbook, because UNISA can't dispute the content in the textbook in terms of how you should be doing certain workings and calculations. So as long as you're approaching your studies the right way, you should be okay. Right, so just some general background. You're aware of this. Obviously, the textbook is the main source of information. So the notes that I have speak to the content in the textbook as well. So I will reference one or two pages in the textbook that are valuable in terms of bookmarking and keeping that aside for later assessments. You know that practice is important, so I will send you a past paper pack, and then obviously in the next session, the next four topics after the ones that we're covering today, there are two longer sections, but the last two are quite short. So we will have a bit of time in the next session to maybe go and discuss a few maybe questions that you might have looked at perhaps ahead of time that we can maybe look at. I know you had some questions about your assignment. We could even do that in the next session. It's up to you, but you can let me know what question you'd like to cover. If there's nothing specific, then we can just choose a question and then we can go through it. And then
Okay.
just in terms of the exam date, when are you actually writing? When is the final
So,
exam?
so the exam dates have not been
Oh, they haven't.
released yet.
Okay,
No.
because then I was gonna, similar to FIN 3701, I was going to give you an extra consultation, so just an hour, but in the week before the actual assessment. So we're hosting content, we're covering theory. I'll send you a past paper pack with all the questions that I've done in the past, and then once you know when your actual exam date is, so once they've confirmed it, once UNISA says, okay, this date, this time, this is the date that you're going to be writing your exam. Then a week before, on one of the Saturdays, then we can host an hour Q&A, and then you can just attend and literally ask me anything that you want help with, either based on maybe the past papers or based on any of the assignments that maybe you've looked at, or whatever you want to. It's totally up to you, but I will leave it open to you, and you can decide when you want to host it. But yeah, just let me know ahead of time when the exam is, and then we can just plan a Saturday either a week before, 2 weeks before. We can decide later. But yeah, please let me know when you have that information, and then we can plan around that. All
Okay,
right.
thank you. That will be great.
Yeah, perfect. All right, so I'm going to start off just looking at some assumed knowledge. So the nice thing about having completed FIN 3701 is you have all the basics. You do need to look at some of those chapters, and just remember that when you're looking at this module, the emphasis is on working capital. And this is looking at short-term capital management. So in other words, you're looking at things like current liabilities, current assets. So you need quite a few like points that you've seen before, and you also need a bit of knowledge of accounting, and even a bit of tax in terms of depreciation. But we'll look at that, and we'll cover it, and we'll discuss it. But yeah, you do need to remember some of the work that you've covered before. So I have recapped a little bit of it, just to get you going with this module. They're separate modules, and they cover different chapters. So you'll see the focus is always on short term. Okay, working capital is looking at short-term capital. Right, the main chapters, let me just open the textbook and just have a look. Okay, so chapter 3, financial statement analysis, that's something that can come up. This was tested previously, but obviously topics that can come up and will be assessed potentially. And this is looking at content from before in 3701. And then you've got the payout policy, which is chapter 14 in the textbook. And then you've got chapter 15, which is that working capital and current asset management. That's the most important one that we need to look at in terms of short-term decisions. But yeah, ratios are important. Sometimes ratios can come up, and sometimes ratios need to be used to calculate certain amounts in a bigger question or longer question. And then obviously dividend payout or payout ratio. Payout and retention is always something that's important when looking at your financial management modules, because businesses can either keep profit or they can pay it out. And obviously that's going to affect the firm value depending on what the company is doing. All right, so that's just something to note, just some basics. There's a few slides just highlighting the overall scope. So when you're looking at topic 1, which is the first topic, the focus is on cash flow and financial planning. So we need to remember that in financial management, when we're looking specifically at cash flow, what are we looking at? Like, what is the focus here? What is cash flow? How would you describe cash flow?
So basically it's like your ability to meet your financial obligations.
Okay, that's good. So you're looking at a concept of liquidity, perhaps. So in accounting,
Okay.
when you did ratio analysis, one of the areas in terms of ratio analysis covered liquidity. And liquidity is obviously a measure of being able to get cash from assets. So it could be any asset, actually. And obviously, if we've got very liquid assets, it's easy to get cash and it's easy to pay certain liabilities to continue operating. All right, so if we're looking at cash flow, it's purely inflows and outflows.
Okay.
And we're looking at almost like the lifeblood of the business. So any business is going to require cash in order to operate. Right, when we're looking at the financial planning, this word planning speaks to what time frame? The past, the present, or the future?
The future.
Good. Okay, so one of the concepts that are covered or emphasized in this module, okay, you didn't cover budgeting in the first module. In FIN3701, you did calculations based more on capital budgeting. So you looked at concepts where you've got an amount of capital and you need to allocate that capital to various projects. You might have calculated your initial investment, your OCF, etc., and then you had to make a decision. You had to evaluate how good that project is in terms of generating value for the business. When we're looking at this module, the emphasis is not so much on decision making from a long-term perspective, it's short-term decision making. So cash flow, inflow and outflow, that's a daily thing that we need to manage. Remember, we're going to be buying and selling inventory perhaps. We're going to be using inventory to create various products. We could be in the manufacturing industry and then we're creating finished products to sell to our end consumer. The focus in this module is always day-to-day. So cash flow is a day-to-day thing that we need to manage. And then financial planning is looking at, well, if I've got a certain number of resources and I have this short-term finance that I'm trying to manage or control, what am I going to do with that in order to keep the business running? So it's very operational. If you've done any of the operational management type modules at UNISA, you would have looked at like processes, maybe like efficiency or trying to optimize like different systems, etc. So when focusing on this module, just remember it's day to day, it's every day, it's operational. It's not so long term in terms of focus, it's very much like on a month to month basis. Okay, you could budget for each month, you could budget for a quarter, you could budget for a year, and you can budget for longer. But with budgeting, obviously the longer we budget for, the more potential inaccuracies can materialize in terms of not being accurate with our expectations. Right, so if you think about Like, let's just talk about 5 years ago. 5 years ago, we would have been in 2018. Okay, in 2018, I don't think anybody would have predicted or expected the world to be where it is today in terms of having gone through a pandemic, experiencing a conflict in the Ukraine with a global like potential war perhaps, high inflation. I mean, the rand is a lot weaker now than it was before. So that's obviously long term. Okay, when you're looking at this particular module, it's all day to day. It's very operational. Okay, and it's looking at concepts that we're going to be diving into more detail, but again, always looking at this. How does it affect our operations? Right, so for example, one of the topics that I've always seen them test is the cash conversion cycle, triple C. That always comes up in an exam. Okay, I will highlight which sections I feel are more important in terms of past papers and what I've gone through with students in the past. Just remember, UNISA will test theory, so you do need to be familiar with all of these concepts, but obviously they like certain sections more than others. But the emphasis is always going to be on short term, and you need to think about that. It's operational in nature. Right? It's operating activities are day to day. We need to make sure that we can address that in whatever context they give us. All right, so you've got a bit of a summary here. You'll see this module covers all of these different areas. Okay, we're obviously looking at financial planning, the process, okay, a bit of theory, right? Analyzing the firm's cash flow, right? You'll see free cash flow, you'll see OCF, you'll see those things coming up again. Again, a little bit of assumed knowledge from FIN3701, but you need that knowledge from FIN3701 in order to expand here, because this is looking at the practical aspects of having made a decision in the past. But when you did FIN3701, you would have looked at, okay, I'm going to take all this capital, I'm going to invest this capital in a project, and now this project is going to run. That project is going to run for however many years or months, and obviously on a day-to-day basis, there's going to be certain working capital requirements that are required or needed to keep the project running. Well, I don't know how much of FIN3701 you remember, but just to highlight something that you might maybe remember, if you go back and you think of your calculation for your initial investments, when you have that cost price, then if it's a replacement decision, you've got to subtract the value of the old assets. But there's a line item in that actual calculation that speaks to the changes or the change in working capital. I don't know if you remember that. Does that like mean anything? The change in working capital.
Is it your net working capital now?
Yes, that's correct. Good. Yeah, so in one of those formulas, either in the textbook or in the notes or in past papers, you would have seen that they speak to that change in net working capital. Okay, so the change is what we're looking at here in terms of working capital. So everything in this section or this module, all of these different sections or topics will cover something that relates to this, the actual management on a day-to-day basis, right? So all of these topics are separate in the actual textbook. Okay, you'll see there's different chapters. Some of them require certain workings, like time value of money. This chapter, the debtors, receipts, and disbursements, that's quite important. I've always seen them test that as well. Okay, you've got to predict or provide for debtors, okay, and the collection and so on. Inventory, I've also seen them test that. That's also quite an important chapter because they test things like EOQ and reorder point, etc. Cash conversion cycle, I mentioned it earlier. You will always see a question on that. Right? It's a given. You're going to get a question on the cash conversion cycle. You're going to have to calculate the various components that make up the cash conversion cycle. Right? But we'll cover all of these in separate slides. Okay. So that's just a nice overview or a scope, just to give you the context. Okay, remember, topic 1 obviously covers cash flow and financial planning. Right, we're looking at those two key concepts, so this block and that block. All right, so let's have a look at the first study unit. Okay, we're looking at cash flow. Okay, this relates to your, actually two modules in FIN2601 and FIN3701. Both speak to cash flow, but just from a different perspective. So in 2601, you would have just calculated like time value of money concepts or principles, and then just choose the correct answer in a multiple choice. In 3701, you had to build up a long question highlighting all the different cash flows in a project, etc. Right, in this module, we're just looking at the firm's cash flows, okay, and how is that going to affect the day-to-day operating of the business. Right, so the focus here is more on OCF than anything else. Okay, remember, we're not looking at initial investment. That's long-term capital budgeting. That's FIN3701. If you're looking at terminal cash flow, that's obviously at the end of the project when you basically wrap up the project and maybe sell all the machinery or cash out, and then you're going to obviously evaluate over a period of time what this is, the OCF. Okay, so OCF is something you've seen before. OCF is obviously looking at operating cash flow, right, on a day-to-day basis. Right, so if you've looked at the learning outcomes in this particular chapter, right, you need to explain what depreciation is. Right, depreciation can come up. You do need to know how to calculate depreciation, so quite a bit of accounting knowledge that you need to remember. Okay, we need to remember the difference between straight line method and diminishing balance. We also need to know how a cash flow statement differs from an income statement. Right, cash flow is focusing on what we're looking at here in financial management. Obviously, the income statement is what the accountants are looking at from a profit and loss perspective. Right, so you've got two separate, let's call them disciplines. Okay, you've got a cash flow financial management consideration, and then you've got an accounting or income statement consideration in terms of profit and loss, which is more performance based. Okay, so looking at how well the business has performed, not looking at how well the business has managed its cash flow or its money. All right, so those are two concepts that we'll look at. You do need to know what those statements look like and how you can use that information. I've never seen them ask you to draw up like a detailed IFRS compliant set of financial statements. Okay, because if they did do that, they would have been an accounting module, not a financial management module. So we need to know, we need to have a working knowledge of the financial statements, but we don't need to know IFRS in detail in terms of disclosure and how to create a set of financial statements. Right? As long as you know what each statement provides you with in terms of information, and you know how to read and interpret that information and use that information in the context of financial management, then you should be okay. And the last bit is just looking at operating cash flows and free cash flow. Right, this I've seen them test quite a bit. Free cash flow, they quite like this whole cash flow part of the first topic. Okay, but yeah, we'll get there eventually, and we'll cover some more practical questions at a later stage. Okay, so just some basics. We're still looking at topic 1. We're still looking at this concept of cash flow. If you look at the textbook on page 91 to 91 to 142, you've got all this information looking specifically at the firm's cash flow. Okay, let me just check the page reference. Okay, yeah, cash flow and financial planning. This is on page. Okay, in the second edition, I think this might have been a different edition of the textbook. I see it's actually page 104. All right, on page 104, let's go to page 104, and it ends on page 150. Okay, let me just update this actually. Okay, so textbook chapter 3, we're looking at, it's actually chapter 4 in the second edition, I see. This might have been the first edition. Okay, we've got cash flow and financial planning. Right, if you go look at the content, just the first page, you'll see, let me just get to the right page, 104. Okay, there we go. Right, they've given you these nice little case studies. For example, here they talk about Apple. Right, investors finally take a bite out of Apple's cash hoard. Okay, if you look at the actual learning outcomes, they've described all of the short-term decision making that's going to take place here. Okay, look, understanding the financial statements, discussing the operating cash flow and the free cash flow. Right, and then they've given you a nice little diagram here looking at cash and how cash flows around the organization. And you'll see, if you're looking at the firm's cash flow on page 107, right, you can see they say in figure 4.1, this illustrates the firm's cash flow, and it can be divided into operating cash flows, investing cash flows, and financing. Right, so when we're looking at accounting, okay, you should remember that there's cash flow from operating, financing, and investing activities. Okay, that's quite obvious. I mean, if you think about money, there's only three things that you can do with it, right? Operating is you can spend it. That will be day-to-day living, okay, day-to-day operating. And that's what this module is focusing on. Right. Obviously, financing is looking at raising capital. Where are we going to source capital? Right. That would be FIN3701. Okay, are we going to use debt or are we going to use equity? How are we going to finance our capital requirements? And then you've got investing the capital, also part of FIN3701. Okay, where we're going to allocate that capital that we've raised. Okay, so when you're looking at accounting, all of this is given in a cash flow statement. Okay, you need to think about that in terms of direct and indirect. Have you done accounting before? How much accounting have you done? Does direct and indirect mean anything to you from a cash flow point of view?
So I have done accounting. It's actually one of my very weak
Okay,
modules.
it's fine.
I'm
You
not
don't,
very good at.
yeah, you don't have to be very strong at accounting to do well in this particular module because, as I said, you're not going to be drawing up these financial statements, but you're going to be using the information in those statements, and you need to think about the way that that information is disclosed. Okay, because when I'm looking at cash flow, there's going to be two methods that I can use to create it or to analyze it. I can either use a direct method, okay, so like a top-down approach, or an indirect method, so a bottom-up, okay, because I don't know if you remember, but in a cash flow statement, if you use the indirect method, you start with the profit, okay, the profit for the year, the profit before tax, and then you adjust for these various like non-cash items, right? But yeah, not so important, but the structure is not so important, but the concepts, the theory that's covered in the cash flow statement is important. So just highlight or just note that when you're looking at a diagram like this one, it's a nice little summary. It's quite, complex because they've shown you all these arrows here and there and everywhere. But remember, if you're grouping these cash flows together, you can see there's a block around operating cash flows. Okay, there's a block around investment cash flows, and then there's a block around financing cash flows. Right, you can see all of them focus on something different. Okay, where is our focus? It's on operating. So everything on the left of the diagram is what we're going to be analyzing in more detail. Okay, you can see here they talk about taxes, revenue, looking at debtors, looking at creditors, looking at accrued wages. That will be a payment for employees' effort, okay, but it's an accrual, all right, so something that needs to be managed, okay, from a short-term creditor or short-term liability point of view. All right, and these are things that you'll see later on. Okay, so just overview-wise, remember, we're analyzing cash flows. We're looking at this concept of operating cash flow or OCF, something you're familiar with. OCF is always looking at day-to-day, okay, month to month. All right, so financial managers, what do we need to do as a financial manager? The first thing is to manage your day-to-day capital requirements. Okay, this is what you require, okay, on a day-to-day basis, because remember, if you're operating, right, you don't want to be running a business and then you run out of money. Now, how are you going to pay your staff? Or you don't want to be running a business and you run out of resources. Now you're going to be like, okay, where am I going to get the ingredients to continue operating? Okay, to provide meals, perhaps if I was a restaurant. Those are things that you need to consider. So day-to-day running of the business. And then you've also got planning. All right, so planning is budgeting. It's looking at not now, but in the future. It's an expectation. All right, so it's using information and making provision for things. All right, so you might have an expectation. Okay, budgeting is planning, but practical. In other words, you're looking at forecasting and you're looking at actually like the detail. Okay, so you can have a plan, but if you don't have a plan of action, then nothing is going to like happen in the business. So the business might have a plan. Okay, they want to expand their operations, that's fine, but then they might need to budget or forecast certain income or expense line items. Right, and then obviously as a financial manager, the word manager is something we've looked at a lot. Okay, obviously your job is to make a decision. All right, but remember, short term always. Okay, so forget about your previous module. Just think about short term on a day-to-day basis. Okay, if I'm planning, budgeting, and providing for the operational requirements of my business, okay, what am I going to need to make in terms of decisions that'll help me going forward? Okay, that'll help the business run smoothly without any problems. Right, and obviously this points to this, the ultimate goal. And this you've actually covered before. It's covered twice. It's covered in FIN3601, it's covered in FIN3701. Do you remember what the ultimate goal is for any firm, any business? What is the ultimate goal?
Profit maximization
Okay, profit
or increasing
maximization.
firm value.
Yes, that's better. Okay, profit maximization is a byproduct of creating wealth. So wealth maximization is actually the right answer. Wealth maximization. Okay, profit maximization is important from an accounting point of view. Okay, again, let's just spend a minute just discussing that topic. Wealth maximization means I'm going to increase the value of the business over time. Profit maximization is just looking at, well, increasing sales. Is it possible to increase sales without, or is it possible to increase sales at the detriment of wealth?
No.
Yes. Okay, what happens if I sell everything? I sell everything on credit to everyone. Is that a good idea?
No.
Okay, that's a great idea if you're an accountant, then that's going to definitely boost your sales, right? If you're selling everything on credit to everyone, your sales is going to drastically increase, so you're going to have a very, very, very big profit, but no cash flow. Right, so have we increased the wealth of the organization? Definitely not.
No.
Okay, what you've actually done is you've used up all the resources, you've given all the stock away without any payment. You've raised more capital to buy more stock, to give more of it away without any payment. So cash flow is going to be affected. That could actually harm the business rather than help the business. If you're selling everything on credit and you're not going to collect any of the outstanding amounts, you're going to end up with bad debts. Right, so now you've got, just to elaborate on this point, you've got cash being used to buy inventory. You've got inventory that's sold to a debtor. Okay, so up until that point, everything looks good. Okay, cash, obviously, we want to maximize our value. All right, so if I had 100 Rand, okay, no one on this earth is going to give me 200 Rand for a 100 Rand note. That wouldn't make any sense. All right, so if I had 100 Rand, okay, I'm going to have to buy inventory worth 100 Rand, do something to the inventory. All right, so change it, transform it. Okay, and then I'm going to sell it to somebody at 200. That somebody will willing to pay. All right, I could buy 100 Rand worth of inventory, so raw material, and I could convert that raw material into something that someone would pay me 200 Rand for. Okay, so up until that point, that's looking good. Okay, this is called the cash conversion cycle, something you will see in one of our modules. Okay, so I'm just highlighting this now because you'll see later it's about wealth maximization, it's about managing cash flow, not about increasing profits. Okay, what happens if the debtors, or let's use a good scenario. If the debtors are good, okay, if I've screened them, if I've given credit to the right people, then ultimately they're going to pay me cash. I'm going to receive cash. All right, and look at what we've done. We've literally created more money. We've created more wealth. We started with 100. We had to do something. We had to use credit. And at the end of it, we've got twice as much cash as we had before. Right, so that's called the cash conversion cycle. Right, if we're looking at this, profit maximization, if that's the only thing that you're wanting to achieve is profit, well, you're not going to be worried about this. Delete. And you could end up with this. Bad debt. So everything that you saw there, now becomes bad. Okay, you thought you had 100 Rand, you thought you were going to collect 200, you didn't. Okay, you had inventory, okay, but now you've given away, so you don't have that anymore. You thought you had a debtor, which was an asset, but they've run away, they can't pay you. So what do you end up with? Bad debt. Okay, this is obviously a detriment to the business. Why? Because everything good here became bad. Why? Because you didn't manage your debtors. You didn't follow up. You didn't collect. Okay, that's the problem with debtors, is you have to manage that relationship. You need to send statements, you need to follow up, you need to call them, you might even have to take legal action if debtors are paying late, you might have to charge them interest, okay, if they're not paying, you might have to take them to court, etc., etc. There's such a lot to consider, right? And that's one of your topics. Okay, we saw that diagram, okay, trade receivables, debtors, receipts and disbursements, okay. All right, so that's just something to note. Again, just overview. Now we can jump into a little bit of the more practical concepts. First term that you need to know, first concept that you need to know is depreciation. Okay, you should know depreciation from accounting. Why? It's an expense. Okay, depreciation is an expense from an accounting point of view. Depreciation is taking the cost of an asset, okay, and allocating that cost over a period of time. All right, so if we're looking at depreciation, it's an expense because it's accounting for the use of an asset. All right, so I can't use the asset and not record anything. Remember, the asset will decrease in value. The asset will be depreciated. All right, when I'm looking at SARS, okay, when I'm looking at tax, this depreciation is called a wear and tear allowance. Okay, and that's something that financial managers can make use of. Okay, remember, accounting is accounting. Accounting is not financial management. Depreciation is expense. That's a bad thing from an accounting point of view. But depreciation is great from a tax point of view because of the tax benefits. Why? Depreciation is tax deductible. Right, so I can lower my income tax for the business if I have more assets that I can depreciate. That's why businesses always purchase more assets. Okay, it's a good idea. The more assets you have, the more depreciation you can account for. And because I'm accounting for that depreciation, I'm going to derive some sort of tax benefits. Okay, the last question here on the screen is, do all assets have the same depreciation? What do you think? Yes or no? Okay, why don't you think so? Can you explain?
Different assets, it depends on the asset, on how long it will last you or how long you can use it.
Okay, that's a good point. So timing is definitely a consideration. Okay, so you're right. All assets have different depreciation rates. SARS is the guideline, or they provide the guideline in terms of how much depreciation you can write off on which assets. Right. Something else to also consider is when looking at these key concepts, okay, that depreciable value, right, will be different for those different assets. I mean, a machine will cost maybe 500,000. You might have a building costing 500 million. So it's all relative. It's all different in terms of the amount of depreciation that you could account for. Okay, and a building would be depreciated by a much lower rate, okay, maybe like 5% a year, versus a machine which might be 10 or 20 or 30% per year, depending on its use. All right, so there's a lot of factors to consider here. All right, the use of the asset, the age of the asset, the type of asset, maybe even the timeline. Okay, how long does the asset last for? All right, so you're right, you can consider those things as well. Okay. When I'm looking at workings, okay, when I'm looking at calculations, you need to know what this is, the depreciable value. Okay, remember I'm looking at a depreciable asset, so I need to know what are the costs that have or that will be included in the cost of the asset. Okay, this is accounting, so I've put a little note here. If you buy an asset and there are installation costs, that needs to be part of the actual total cost of the asset that was acquired. Okay. If I have to set up or install the asset, okay, I'm going to include all those costs. There could be other costs as well that I would have to include. Okay, if there are maybe taxes that I cannot claim, then I would include that. So cost, any cost that is part of the asset's value will be included in the asset's depreciable value. Okay, all right, so an example here. The machine has a cost price of 500,000. There's installation costs of 20,000. What is the depreciable value of the machine?
It's 520,000.
Good. Okay, 520,000 is the total depreciable value, okay, over its useful life. Okay, so the nice thing about depreciation, it applies to assets, right? And those assets can have potential expenses that are attached to them. I mean, installation costs, that's an expense, that's an operating expense. But it's an operating expense that relates to an asset, and I can't use the asset if it's not installed. Right, so when I'm looking at the depreciable value, okay, you will be allowed to include any additional costs, okay, that are incurred when getting the asset into its useful state. Right, so 520,000 would be the total depreciable value, not the 500,000. Even though the machine only costs 500,000, there's still additional costs that you could include to write that off over a period of time. Okay, because over a period of time, you would depreciate the asset at the full 520,000. Okay, does that make sense? Is that all right so far?
Yes.
Okay, all right, just another note, okay, with the life, right, remember we're talking about time. Okay, you are going to see some budgeting, you are going to see some tables, so a table of cash flow. Okay, so very similar to OCF. When you did OCF, you might have drawn up a table. Okay, 1 year, next year, next year, next year. Okay, if it's depreciation, obviously it could be based on a month to month to month to month basis even. Right, so you do need to consider how old the asset is, and you do need to consider, right, how long we still need to depreciate the asset for. Okay, remember, if I buy an asset, there's going to be a certain number or a certain amount of depreciation for a certain number of years, and I need to provide for that. Okay, every asset is different, so the time period will differ. Who gives us the time period? SARS. Okay, SARS will tell you a laptop can be depreciated over 3 years. Okay, a machine can be depreciated over 5 years. A vehicle can be depreciated over 4 years, whatever it is. Okay, different vehicles, different assets all have their own useful lives. Right, so that's where we get the information from. For you in an exam, obviously they will state this in the question. Okay, so just look out for depreciation if they give it to you. Make sure you still know how to calculate depreciation, because it will affect your working, your budgeting. Okay, because remember, depreciation is, let me ask you this, is depreciation a cash flow? Let's add to the slide. Is depreciation a cash flow?
I don't think so.
Correct. Okay, depreciation is a non-cash item. Right, in an indirect method, cash flow statement, okay, you would remove non-cash items from the disclosure. Okay, all right, so yeah, depreciation isn't a cash flow in its like on its own. Okay, depreciation is non-cash. Okay, but depreciation gives a tax benefit that affects cash flow. Right, and that's why you need to always consider it. Okay, so if you remember your FIN3701, when you did operating cash flow, Right, after operating cash flow was calculated, you had to add back the depreciation. I don't know if you remember that. You have to add back depreciation to get the OCF. Do you remember that?
Yes, I do.
Yeah. Okay, because you're adding it back because it's not actually cash flow. There's no outflow. Right. It's a non-cash item. So you need to provide for it in your calculation. Right. When we're looking at the firm's cash flow, we just need to note that there is a tax benefit, okay, when looking at depreciation because of that wear and tear allowance that SARS is going to give us, because I've got an asset that can be depreciated over a certain amount of time. Okay. Right, so that's just a bit of theory, quite a bit of theory there in terms of terminology. You've just got a note here regarding the two different methods. Do you still remember how to calculate depreciation using straight line?
Yes, I remember the straight line method.
Good. Okay, so that is depreciation equals brackets depreciation or depreciable value less residual value times the depreciation rates. Okay, when you're looking at the depreciable value, because I have the straight line method, the depreciable value is the cost price. Okay, if I have diminishing balance, we have the same formula, copy paste. But the only difference is when I'm looking at the depreciable value, I'm now going to be looking at carrying value for this method, diminishing balance. Right, and just a little note, carrying value is calculated using cost minus accumulated depreciation. Okay, so that's just the note. Okay, so just remember, when you have diminishing balance, I need to use carrying value as the depreciable value. Right, so this formula, you could actually rewrite the equation even. Okay, and you could show, not carrying, sorry, cost minus accumulated depreciation. Right, this is the carrying value, obviously. Okay, so depreciable value is the carrying value. The carrying value is what you use to calculate depreciation. Okay, so I see there's a typo here, depreciation. Okay, does that make sense? Happy with that?
Yes.
Okay, so that's just a little note about depreciation. Okay, here's an example just to practice to make sure that you can calculate these amounts. I want to know what's the yearly depreciation amount for this particular asset. Grab a calculator, do a quick little working, tell me what you get.
20,000.
Good. Okay, so there's two ways of doing it. You could have taken the 100,000, you could have divided by
5.
or you could have went with 100,000 times 20%. How do I get 20%? 20% is per annum. Okay, if it's over 5 years, 5 years means 1 over 5 per year, which is 1 over 5, which is 0.20, which is 20% per annum. Okay, so rates can be given in years or rates can be given in percentages, just depending on what the question is providing. So whether you're dividing by 5 or whether you're multiplying by 20% per annum, I'm going to get the same depreciation amount of 20,000. Okay, that's the yearly depreciation. All right, that depreciation will be seen as an expense, which is tax deductible because of the wear and tear allowance that SARS will give us. Okay, happy with this example?
Yes.
All right, let's try this one. Answer?
It's 50,000.
Good. Okay, again, you can times by 12.5%. or divide by 5. Okay, not 5, sorry, 8. Okay, 400,000 divided by 8 is 50,000. Okay, so 50,000 rand depreciation every single year. Okay, 1 over 8 is the same as 12%. Is that right? Let's just double check that. 1 divided by 8, yeah, is 12.5%. That's fine. Okay, next. An asset is worth 300,000. It must be depreciated at 20% per annum. Easy, hey? Answer?
It's 50,000. Sorry, 60,000.
Yes. Okay, 60,000 is correct. 20%, 60,000 a year. Okay, good. Right, here's the one looking at diminishing balance. Okay, be careful. Right, we need to draw up a schedule for depreciation. Okay, this needs a table. All right, so let's draw up the table. Okay, I don't know how you've done depreciation calculations in the past. I'm just going to show you this method because it's easy and it always works. How many years do I need? I need 4 years because of the 25% per annum. Okay, so we draw up a little table. The table looks like this. There's 5 columns in the table. Okay, in the first column, you've just got the year, or the time, the period. Second column is the costs. Then you've got depreciation. And then you've got accumulated depreciation. And then you've got carrying value. Okay, so that's what you have in the actual table, and then you just need to complete the table in terms of what the asset has in terms of amounts. Okay, so obviously I'm going to use 4 years here because of the 25% per annum. Okay, the cost here is 100,000. Right, will the cost change?
Yes.
No, the cost never changes.
No.
Can you change the cost price of an asset that you had purchased previously?
No.
No, we can't go back in time and undo the transaction and then redo the transaction. It's not allowed. Okay, the cost will never change. The cost will stay 100,000 every single year until the end of the asset's useful life. The cost won't change. Will the carrying value change?
Yes.
Yes, it will. Okay, it'll get smaller and smaller and smaller because the value of the asset in terms of carrying value will decrease because of the additional accumulated depreciation. Right, so if you're using diminishing balance, come, you help me. I want an amount for this one. What's the depreciation the first year going to be?
25,000.
Yes. Okay, what's the accumulated?
Nothing.
Well, it'll be 0 plus 25,000. So for this year, it'll be 25,000. Make sense?
Okay.
Okay, what's the carrying value? How do you calculate carrying value?
You'll say the depreciation value, which is 25,000 minus residual.
No, carrying value. Carrying value is
Sorry. It's minus it's cost minus accumulated depreciation.
Yeah, that's right. Okay. All right, that's the carrying value. So cost minus accumulated depreciation. All right, so what is your cost? 100. What is your accumulated depreciation?
25,000.
So what's the answer?
75,000.
Correct. Good. Okay, next line. What's depreciation here going to be?
25,000.
Nope. This is diminishing
50.
balance. If it's diminishing balance, how do you calculate depreciation?
The cost?
Nope. You don't use cost. Diminishing balance, we use which method? Let's go back. What do you use to calculate depreciation if you're using diminishing balance?
Carrying value,
Good. What is the carrying value here?
75,000.
Yes, there we go. Okay, maybe we should add this additional working here. Okay. Okay, do you see what you're doing? You're
Yes.
taking the depreciation, well, you're calculating the depreciation, taking the carrying value into consideration. Right, grab the calculator. What is 75% times, 750,000 times 25%? What do you get?
187,500.
Ooh, that's too big. Too many zeros. 18,750. That's what you're getting. Is that right?
Yes.
Okay, accumulated depreciation in the second year, how much would that be based on our depreciation for the current year? Remember, we're looking at year 2. What is the accumulated depreciation in year 2?
25,000 plus 18,750.
Nice. Okay, gives you another answer. Let's see what we get. 43,750. Are you with me?
Yes.
Okay, carrying value here, what is it?
It would be the 75,000 minus the 43,000.
No, you don't change the formula. What is the formula for carrying value?
Cost minus accumulated depreciation.
Yeah, so what's the cost?
100,000.
Yes, not 75. Okay, be careful. You're using this column and that column. Does it make sense?
Yes.
Okay, this minus that gives you this carrying value.
Okay.
So what do you get? I get 56,250.
Yes.
Okay, next line. Give me the depreciation for this year.
It's 56,250
Yeah?
times by 25%.
Yeah, good. Okay, this is representing the carrying value. Okay, carrying value times 25%. So what do you get?
14,063 rand.
Yeah, you can round it off. Yeah, we can round it off. Let's leave it. Yeah, 62.5. So 63. Okay, that's fine. Okay, accumulated. Actually, let's don't
Yeah.
round it off. Let's just keep it full numbers instead
Okay.
of rounding it off. Okay, this one.
57,812 rand.
Ah,
50.
good. You added. Nice. No, 57, 812.5. Okay, is this making sense?
Yes.
All right, and then the last line. Okay, well, let's first work out the carrying value. Obviously, you've got to subtract, eh?
Yes.
Okay, so 100,000 less that gives you 42,187.50.
Yes.
Okay, right. Do you get the big picture here? How to calculate depreciation? This is more just a reminder from
Yes.
accounting, making sure you can do these workings using the correct formula. Times 25% equals. Okay, so last depreciation amount is 10,546. Okay, this one we are going to round off, 88. All right, and then add again. Okay, let's see what I get. Adding it up. 57812.5. I'm getting 68.
359.
Yes. Point.
38.
Yes. Okay. And then just to subtract. All right. Last answer. 31,640.6362. Okay.
Yes.
Happy.
Yes.
Okay, good. All right, so just remember, when looking at depreciation, you get different methods. All right, this is the difficult one because you literally have to go line by line by line by line by line in order to get the correct amount. Okay, just remember carrying value here is calculated. Let me change that to red actually. Okay, and then let's make that red as well. Okay, next. All right, there's the note from your accounting knowledge. Okay, cash flow. Firms can categorize cash flow according to operating, investing, and financing. Right, when you're looking at those cash flow statements, you'll see operating activities, you'll see investing activities, and you'll see financing activities. Okay, because I'm looking at operating, okay, it's day-to-day running of the business. So anything that relates to the operations of the business, making products, selling products, okay, all of that's operational. Investing, we're looking at long-term, right? So this is that whole idea of cash, right? What do you do with your money? Well, you spend it, you spend some of it, you should save it and invest it, okay, or you're paying off loans, financing. Debt. Okay, you're financing debt. Right, so that's what you're looking at here when you're looking at cash flows. Okay, remember, those statements provide you with this information. You can see the operating cash flow, you can see the investing cash flow, and you can see the financing cash flow within the organization. Right, just remember what each of these cash flows relate to. Okay, is that all right? Your accounting is okay?
Yes, that's
Okay.
fine.
Right, then just a little note here. There's an example looking at inflows and outflows. Okay, do all transactions have a cash flow? Right, let me just check the page number. We're looking at cash flow. I think the page number might need to change as well. Let's just check here. Okay, I see free cash flow. Yeah, okay. All right, the cash flow statement is here on page 111 in the second edition. 111. All right, page 111, you've got a cash flow there for Tugela Company. You've got operating, investing, and you've got financing. Right, and there's a little note in the textbook interpreting the statement and then calculating OCF. Right, operating cash flow, remember, is day to day. Right, so question quickly, do all transactions have a cash flow effect?
Yes.
Really, all transactions? All transactions. Do all transactions have a cash flow effect?
Okay, so credit won't if
Credit
you're selling
does.
credit.
Credit does, but credit has a delayed cash flow. So if I sell something on credit, when do I collect the cash?
Yeah, that's in the future.
Exactly. All right. What doesn't have a cash flow? We just looked at it.
Depreciation.
Yeah. Okay. So no. Okay. Depreciation. There are others as well. Profit on sale or loss on sale. A revaluation or some sort of or bad debts. That's it. That's a better one. Okay. Bad debts. That's also no cash flow. Okay, when you write off a debt that doesn't pay, do you pay anyone? Is there a cash flow?
No.
No. All right, so not all transactions have a cash flow effect. Okay, the big one, the important one is the depreciation. Right, and you'll see there's a working. In your textbook, there's two formulas for OCF. All right, here they're here. Okay, so this is a little bit of recap and revision from your previous module. Okay, remember OCF is operating cash flow. This is looking at cash generated from operations, right? If I'm looking at the income statement, okay, this is the indirect method. Okay, indirect meaning I'm starting at the bottom. Okay, if I'm starting at the bottom, I need to provide for non-cash items. All right, I have to take out the depreciation because depreciation is not a cash flow in order to get my operating cash flow. Right, you know this from FIN3701. How did you do in FIN3701? Did you get a distinction? What mark did you get? Final
I
result.
did. I had a distinction.
Well done. Okay, that's really good. So you know when you're drawing up OCF, you need to take out depreciation. When I say take it out, we have to add it back. Does that make sense?
Yes.
Okay, because remember, in the income statement, okay, as part of the operating expenses, you would have subtracted the depreciation. And that's fine because that's going to affect your profit for the year, which will be lower because of the tax benefit of writing off depreciation. But when I'm looking at OCF, I don't care about the actual depreciation being part of the working. We need to remove it. So by removing it, I need to add it back. Okay, so just remember, it's something that you have to do. You have to add back the depreciation always. Right, once you've got net profit after tax, okay, it is possible to work backwards. Just remember, I've put a little note here. The arrow is here for a reason. Sometimes a question will give you this, the earnings before interest and tax. Then you've got to take out the tax to get the net profit after tax. And then you can calculate the OCF. All right, so just look at, just remember this one little diagram or picture or bookmark it if you need the formula. Right, and these formulas are in the textbook. Okay, these texts, as I said, the textbook's very good. They highlight all the workings and they provide very good theory to cover this module. Let me just check here. I don't know if Teams will time out. I know when I log into the Teams Microsoft thing, it says there's a 60-minute time out. If it does time out, then just rejoin. I think we're doing okay. It's
Okay.
It's 10. It's what? It's 6 minutes past 10, and we're still going. So that seems fine. Okay, maybe that restriction doesn't apply to a single person being in the class. When there's a group, perhaps, I don't know. I'm not sure. But let's carry on.
Okay.
All right. Okay, here's a little working for you to calculate. Okay, remember the focus is working out OCF. Okay, a little bit of FIN3701 here actually. Okay, there's no needing, we're not needing to work out all the EBIT in terms of sales, cost of sales, expenses, income, etc. You've got the EBIT, you've got the rates of tax, you've got the depreciation. What is the OCF? Let's see if you can do that.
I think it's 390,000.
390, let's check. Okay, OCF equals, okay, open brackets, the 500,000 times 1 minus the tax rates, close brackets, okay, plus the depreciation, which was 25, equals, okay, on the calculator, let's do that calculation. 500,000 times after tax, so 0.73 is 365 plus the 25. What did you say your answer was? 390?
Yes.
Good. Okay, that's the OCF. All right, so those are the type of questions you might see in a question. Obviously, this will link to a specific concept or topic, and we're getting there. Okay, I see the next few slides look at the free cash flow. All right, so as long as you're comfortable with OCF, remember operating cash flow is looking at day-to-day running of the business. All right, we're looking at working capital. In other words, short-term assets compared to short-term liabilities, right? So free cash flow is something we need to elaborate more on, that links to what we just looked at, right? I see we've got 2 more here for you to do. Let me hide the answers. Okay, can you do these 2 quickly and then give me the answers for B and C?
Okay, for the first one, I have 620,000.
Nice, that's correct. All right, the working's
And
there if you need it, but you got it, so that's perfect. 620 is correct. Next one.
255,000.
Let's check that one as well. Yes, there's the correct answer. Okay, there's the working, there's the answer. Very good. All right, so yeah.
Okay.
Cash flow, important. Just remember, OCF, you need to take out the effects of depreciation. All right, last bit of this section is looking at this concept called free cash flow. All right, this is very important. If you do other modules, I think you're doing the I&V module as well. You wanted some videos on that. You'll see there's a whole section on free cash flow in that module, because in equity asset valuation, when you're pricing equity, you need to look at the different, let's call them not disciplines, that's more like a method or a model. So there's a free cash flow model that businesses use to evaluate equity, to price equity. So if you're doing I&V 3701 as well as this one, you'll see free cash flow is spoken about there as well. But remember, that's from an investment point of view. That's from an I&V 3701 point of view, not a FIN 3702 point of view. Okay, so in financial management, in this module, just remember, you do see free cash flow. You also see free cash flow in accounting, but it's not really disclosed, but it is a consideration. It links to the cash flow statement. Okay, so just to make sure that you're on the right page, when looking at this concept, financial management, this module, your free cash flow is the cash available to the investors, which are the creditors and the owners of the company, after meeting all the operating expenditure requirements of the business. Right, we're also going to be looking at the investment in fixed or current assets. Okay, remember, not fixed, not so much the fixed, but more the current. Okay, because we're looking at changes in working capital. Okay, so when you're looking at, and this is important, you'll see it later, not this week, the next week, when you're doing a credit policy calculation. Okay, you'll see if you've gone ahead, I'm just going to put a little note here for debtors later. Okay, evaluating a credit policy change. Okay, so let's assume I'm offering credit to my customer. I'm giving them buy now, pay later type of arrangements. Okay, if I'm going to change my credit policy, how is it going to affect my cash flow? Right, because if I'm going to give them more time, so in other words, let's assume I'm selling goods and credits and I give you 30 days to pay me, but now I want to change my credit policy to attract more customers and I'm going to give you 60 days to pay. That means I'm going to double the amount of time in my credit policy where I have to wait for collection. So if I do that, then I have to increase my investment in my current assets. That means I'm going to have to hold more stock. I'm going to need more cash, because I'm going to now need cash for 60 days instead of 30 days, and that requires more investment. Okay, so free cash flow is looking at literally like physical bags of money that's lying around. So this picture, debt and equity, okay, we've seen it before. You've covered the module, so I don't have to spend too much time describing that. Okay, you know that businesses use debt and equity to fund the operations. Okay, debt and equity is external financing. External financing means other people are giving me this money. Right? It's not earned. It's not generated through operations. Okay, it's coming from outside equity or debt providers. All right. So free cash flow. This is very powerful. Okay, free cash flow means money that's being generated within the organization after operating and after investments in current assets. Okay, the word free, meaning it's not tied to anyone. It's not tied to the loan provider, the debt, the financier. Okay, it's not attached to the equity shareholders. Okay, people giving you finance but wanting a piece of the business. Okay, it's literally money that's lying around that came from where? Operating. All right, and that's very powerful in terms of managing your finances. Okay, any business wants to have lots of free cash flow lying around. Okay, remember that diagram, not diagram. Remember that case study in the textbook? They spoke about Apple. If you do research on Apple, Apple has literally, am I spelling that right? Okay, literally billions of dollars of cash literally lying around in their business. Okay, that's how effective, or that's how good they are at generating cash flow. Okay, it's a premium product. Okay, you're paying for the brand. I mean, the phone probably costs maybe a fraction of the actual value of the phone, but they can sell it for millions or billions or trillions even all around the world. Okay, so there's a reason why that case study came up. Right, if you go read page 105 in the textbook, they talk about the investors finally getting paid a dividend, basically. Okay, because before Apple never paid a dividend. Apple was very, what's the word? They hoarded cash. They just kept it. All right, and they kept it. Why? Because they know what they can do with cash. They know how powerful cash is. Right, if you've got lots of free cash flow, there's a lot you can do with it. So that was their strategy. And obviously it's paid off because now they're one of the biggest and most valuable companies in the world. All right, but they applied basic financial management principles. Okay, make sure you have enough money, make sure you never run out of it, make sure you can always pay for your operating expenses, and make sure you always have enough to cover your current assets. In other words, your inventory, etc. Right, as soon as that happens, then you start building this. All right, you start building up your reserves in terms of free cash flow. All right, happy with that concept? Can we look at the workings? That's just the theory?
Yes.
Okay, let's look at the calculations. This is covered in the textbook. This is also looking at FCF from a calculation point of view. This is covered in the textbook just after your note on OCF. Again, I can link this to your INV module. It's the same in INV. You will see the same formulas in INV. Okay, so if you're covering this now, you'll cover it there as well. When you're calculating free cash flow, this is the formula. OCF minus NNCI, which stands for net non-current investments. Maybe let's highlight those in color. And net current asset investments. Okay, those are the two. Okay, so let's look at the working. All right, you've got non-current assets last year, 2022, 1,000. You've got non-current assets for this year, 2023. Right, you've got the depreciation for this year. Okay, you've got the current assets last year and this year, and you've got the current liabilities for last year and for this year. Don't forget that all of these have a separate working that needs to be calculated. I should have added all the color in. Okay, there we go. And then we can work it out. So, right, it's quite a long working because you have these different components. Right, remember OCF can be calculated separately. You just looked at it. There's the OCF formula. Do you see it? Okay, this formula is going to be used as part of the free cash flow calculation because I need OCF first. Once I've got OCF, then I'm providing for all these additional investments in the operating or the investment aspects of the business. In other words, I need a certain amount of money to provide for my non-current investment. I need a certain amount of money to provide for my current asset investment. Right, so those two need to be taken into consideration there when working out your free cash flow. Okay, because remember, what did we say free cash flow was? Literally, money that's lying around after everything has been taken into consideration. All your operating requirements and your investments in your day-to-day operating, your fixed and your current assets. Okay. All right, so let's start off with, I've got the workings here. I've given you more space just so that you can complete all of these. Okay. Let me start with this one. NNCI. Okay. This is the net non-current investment. Okay. To calculate that, you need the net non-current change. Right. So in terms of our assets, our non-current assets, how have they changed from last year to this year?
They've increased.
Good. By how much?
Are we talking about non-current assets?
Yes.
Okay, by 200.
Good. Okay, do you have depreciation in this question?
Yes.
Okay, remember we said depreciation is provided for on what? Non-current assets. So we need to add that back. So what would your OCF be? Not your OCF, sorry. What is your NCI?
It would be 200 plus 100.
Yes. 200 plus 100 is 300. Good.
300.
Happy with that?
Yes.
Okay, let's go back to the question. All right, forget about that now. Look at the next one. I'm calculating the NCAI. Okay, my investment in current assets. I need to know what the change is in my current assets, and I need to know what the change is in my current liabilities. Right, so what's the change in current assets?
100.
Good. What's the change in current liabilities?
100.
Plus or minus?
Add. Plus.
Correct. Good. Okay, so if you look at the working, you've got plus 100 minus plus 100 gives you no change in your current assets. The net change in your current assets is 0. Right, because you managed to increase your current assets, you managed to increase your current liabilities, they offset each other. So I don't need any additional investment, okay, in current assets. So my free cash flow won't be affected by the change in the working capital, which is the difference between your current assets and your current liabilities. Is that all okay?
Yes.
Okay. Last bit. OCF was given as 450.
450.
Okay. Can you calculate the FCF now? Combine all of that. Let me show you. Okay, combine all of that. What do you get?
150.
No, you're combining all of it. Take this. Substitute. What do you get?
Is it not 150?
150. Okay, let's check. What did you do?
I took the 450 and subtracted the 300.
Yes. Okay, that's fine. Good. Okay. Happy?
Yes.
Okay, I think we have one more working. Yeah, here's one for you to do. Right, I've given you a slide that you can use to do the working, so I'm going to leave the question up. Okay, go through all of it, see what you can fill out in the actual working, and then let's check the answer. Right, as soon as you're done, you can let me know, and then I'll just reveal, and then we can check if you've got the right FCF. Okay, I want to know what your FCF is.
Okay.
Okay, so go through the process, work out your non-current investment, work out your current asset investment, and then see what the actual free cash flow is based on your OCF.
I get 1,000.
Right, let's have a look and check it.
Okay.
Okay, you're getting 1,000. Let's have a look. Ooh, not quite. Okay,
Okay.
let's check your NNCI. Let's see where you made the mistake. What was your NNCI? What amount did you get?
700.
Okay, that's good. What amount did you get for the NCAI?
300.
Okay, here, this is where the mistake came. Right, so
Yes.
the difference here is 600, right? Okay, the difference here is minus 300. Okay, what's a negative and a negative?
Positive.
Yeah, so just be careful of the maths. You have to use the bracket, hey? All right, so 900 here is the change in net working capital. You see your mistake?
Yes.
Okay, just remember, because you're looking at current assets and you're looking at current liabilities. Let me ask you this quickly. If my current liabilities are decreasing, what does that mean in terms of cash flow? Did I pay or did I receive money?
You paid.
Exactly, I paid money. So if I'm paying money, there's actually a cash outflow, not a cash inflow. Does it make sense?
Yes.
Okay, if the current liabilities increase rather than decrease, then it's the opposite. Does it make sense?
Yes.
Okay, so just remember, when you're thinking about accounting, the cash flow is important. You need to understand what is happening. So is it an inflow or is it an outflow, basically? All right, yeah. So just make sure you correct your working. Obviously, OCF was given. It could have been calculated separately, but if you did, you'd have to use that formula we saw on one of the previous slides. Right, the final
Yes.
answer should be 400. Happy with the example?
Yes.
Okay, great. Right, that wraps up this bit. The last thing I have here is just a little note about the financial planning process. Okay, because it's a crash course, I'm not going to spend too much time going through the theory. Just note, though, that it is something that can come up. Remember, the focus is always going to be on short term, though. You're looking at operating. So when they do test you, if they do test you on the theory starts here on page 114. They talk about long-term strategic plans, and then they bring in the capital, the cash budgets. Okay, so we're not looking at long-term. Long-term was FIN3701. Okay, we're looking at short-term, which is FIN3702. That's the one we're looking at. Right, so everything that you're going to be covering now, right, you'll see study unit 2, okay, is looking at what we just spoke about. Financial planning, the process. It's all about budgeting. It's looking at cash. It's looking at planning. It's looking at preparing a budget. It's looking at compiling a budget. It's looking at explaining a budget. It's all budget related. All right, nothing difficult here. I don't know if you budget. Do you budget? Do you monitor your income and expenses on a month-to-month basis?
Yes.
Okay, good. Yeah, that's good financial planning. If you're not managing your budgets, then you won't be able to manage your finance. Okay, so budgeting is practical, financial planning is theory. Okay, so we need to understand the difference when businesses budget. What are they actually trying to do? They're trying to achieve certain goals. All right, so next section is quite short. This one's not too bad. It's a lot of maths rather than anything finance or accounting. I'll show you an example later. It's just highlighting the different changes that could come up in a question. Okay, if you look at past papers, the easiest question is on budgeting. Okay, why? It's mathematical. Okay, if you know how to add and subtract, multiply and divide, you can do a cash budget. It's not a difficult concept. Right, the only thing you need to do is you need to read the question carefully, because the question is going to guide you in terms of how you need to budget. All right, the budget will say something like, okay, this expense is going to increase next year. Make sure you can increase the expense. Or they might say, well, we've got a loan and the loan is going to get charged interest, and now we need to provide for the interest in our calculation. All right, so if I was you, if your maths is quite good, if your maths is quite strong, you should hope and look forward to a question on cash planning or cash budgets. It's an easy question. Every past paper that I've looked at with students in the past, it's never been difficult. It's always been very straightforward, very easy, because of this. It's mathematical. Right? If you don't like maths, you might find it a bit tricky. But if you do like it, you'll find it quite easy. All right, so your perspective, how good is your maths?
I like maths.
Okay, then you'll find
Yeah.
this section quite easy. It's not a difficult section at all, and it normally carries around 10 marks, maybe even a bit more. Okay, in longer questions, I've seen it for about 20 max, but in short questions, about 5, maybe 10. But you will always see a question about it. It'll always come up. All right, so quick question. What is a cash budget? Do you know?
So it's budgeting your like liquidity, your cash on hand.
Yeah, so it's all cash related, so it's inflows and outflows. Okay, you don't look at accounting. Remember, this is not accounting. I can't emphasize that enough. This has got nothing to do with accounting. This has got everything to do with managing money, inflow versus outflow. Okay, I don't care how much sales I've made. The only thing I care about is how much money did I collect from the sales that I made. That's cash budgeting. All right, do you budget? You've answered the question. You do. That's good. Do companies budget? Yes, they do. Okay, so companies need to budget because they need to manage cash flow. Okay, businesses that don't manage cash flow, they fail. All right, so businesses that go bankruptcy, okay, no more cash. Okay, that's the only time you'll ever go bankrupt as a business or even as an individual. All right, as soon as you run out of cash, okay, that's it. That's the end. Okay, it's the end. Okay, no more cash, meaning I can't even take out a loan. Nobody wants to give me a loan. Nobody wants to give me more money. We're going to go bankrupt. Right. A simple example I can give you, something like Eskom, right? Okay. Does Eskom create cash flow? Do they have more money coming in compared to the money going out?
I think they do.
Okay, well, government is helping this. So operating cash flow, it would be bad. Okay, but financing cash flow is good. Okay, so without government's help, this business would never have been able to continue running in the foreseeable future. Right, so it's all about this, managing cash flow. Okay, you can continue forever and ever and ever as long as you can get money from somewhere. Okay, if it's from government, that's fine. You can still operate, even though the business doesn't help generate more cash. Okay, so that's the rule to take away. That's the principle that we need to remember. Okay, this is more theory, again, just from the textbook, just highlighting some of the basic points. The first thing is, when I'm budgeting, okay, remember, budgets are generally going to be for a few months, At most, maybe a year, maybe 2, maybe 3. Some businesses even budget for 5 years. They have like a 5-year plan. Right. There's nothing wrong with budgeting for 5 years, but what's the problem? Are budgets accurate?
No.
No. Okay, we touched on this point earlier. Okay, if we drew up a budget in 2018 and we had to look at that budget today in 2023, so much has changed in the last 5 years, that budget would definitely not be accurate, because in 2018, the world was in a different place. In 2023, same thing, the world is in a different place. Who knows where we're going to be in 2028, in another 5 years? All right, so just remember, the textbook talks about risk. Okay, luckily, you don't have to look at risk. Risk was mentioned in your FIN3701 module, where you had to provide for risk in different models to create a expectation of cash flow, so you could do your discounting in order to calculate your your NPV, your net present value. All right, so when I'm looking at cash budgets, none of that's going to come up. So you don't have to worry about risk. You don't have to worry about anything, because they're going to tell you everything in the question. Right? When you're forecasting, okay, you're going to look at what UNISA says you need to do. Okay, they're going to tell you this expense, the sales are going to increase, and then just process the increase. They're going to tell you the expenses are going to increase the expenses, and then calculate what the cash flow is going to look like going forward on a month-to-month basis. Okay. You said your maths is quite good, so I don't think you'll have any problem with this section. Just a few notes here. Sales, they generally ask you to amend or change. You'll see questions where they talk about a sale. I sold a certain amount of goods today, okay? A portion of it was cash, okay? And then the rest of it is debtors. Right, do I receive that money today if I'm selling goods on credit?
No.
No. All right, so if I collect 60% of the sale today, the budgeting, inverted commas, or the forecasting, is what you're looking at in the month to month. Okay, and I'll show you that on the next slide. Okay, sales, there's a lag. Okay, the lag that I'm referring to is the debtors, the debtors collection. Okay, and this comes up in tests and exams. Okay, they will describe a scenario. They'll tell you, okay, this business is generating a certain number of sales. They're going to tell you a portion of the sales is cash. They're going to tell you a portion of the sales is credit, and then they're going to ask you to draw up the budgets. Okay, that lag needs to be provided for in the actual budget. So if I sell on credit, if I sell 60% cash, how much is credit?
40%.
Good. All right, notice that 40% can be collected 30% in the next month and 10% in the last month. Do you see the difference, like in time, in terms of timing?
Yes.
Okay, and that's kind of what they're going to be giving you in the actual exam. Okay, but as I said, it's mathematical. It should be easy. You should like these types of questions. All right, so I've given you an example here, just to help you with this whole concept of like forecasting and changing these expenses going forward. Okay, all right. So if I'm looking at a budget, obviously I'm looking at a month to month to month. This total column will also be provided for, okay, because we need to look at the big picture. Okay, you might be budgeting for a quarter, then this will be the total for the quarter. Or if you're budgeting for the year, that'll be the total for the year. Okay, so just remember that when you're drawing up a budget, you're going to have lots of columns and you're going to have a lot of rows. Okay, did I give a percentage here? No, I didn't. So let's just put one in. Okay, we can forecast and analyze future expected cash flows. We're going to assume, okay, receipts are going to increase by 10%. Payments are going to increase by 20%. Okay, let's see what this budget is going to look like. We're only going to budget for 1 month. All right, so let's see how good your maths is. Can you increase your receipts by 10%? what would the receipts be in month 2?
1,100.
Good. Okay. Can you increase your payments or your disbursements by 20%?
That'll be 120.
Good. So the final answer should be 720, right?
Yes.
Perfect. Okay. Now you need to remember when looking at accounting, okay, this is month number 1. Month number 1, good month, yes or no?
Yes.
Good month. Okay, why? The cash flow was positive. Do you agree?
Yes.
Okay, how much money did we start with? 100. How much money did we end with? 500. Do you agree the money you end with in month 1 is going to be the money that you start with in month 2?
Yes.
Okay, that's important. All right, can you complete the table? Give me this answer.
It's 380. No, sorry, 480.
No, your first answer was right.
Oh, okay.
Yeah, you can double check it. If you type 1,100 less 720 on your calculator, you do get 380. That's
Yes.
good. Is that good cash flow or bad cash flow?
It's good.
It's good. Okay, so what's the cash flow at the end?
It's 880.
Perfect. Okay. All right, and obviously that would continue in month number 3. This end balance will be the starting balance for the next month. Do you agree?
Yes.
Okay. And you could do that for many, many, many months. You could do that for a quarter, a half year, a full year, 2 years, 3 years, and you could predict or you could estimate the cash flow. And you could look at, is this business bleeding money or is this business making money? That's what we need to look at, right? Okay, so if we're looking at the total here will be 2,100, okay, which is adding up. This will be 1,320. This will be 780. This will be, okay, obviously that won't have an aggregate. Okay, just be careful. Right, you won't have an aggregate here for the balances. Okay, remember the balances will change month after month after month. They're adding up as we go. Right, but if we're looking at month on month on month, those totals will tell me how well we've done over the month or the months or the year or the quarter or the half year. Does that make sense?
Yes.
Okay, so just bear that in mind when you're doing calculations, especially when they're asking you to budget. You need to read the question very, very carefully. Right? And I will send you some past papers. You will see some of the types of questions you'll get asked. If you like maths, you will find this section very easy. Okay.
Okay.
Right. Are budgets accurate? We already said no. Can we cope with uncertainty? The answer is yes, but this is beyond the scope. Okay, luckily they're not going to ask you to make provision for things like inflation. They're not going to ask you to make provision for rising or additional costs or unforeseen costs. All right, so I've just added this purely from a textbook point of view for completeness. Scenario analysis is what you use to provide for best, worst, or other case scenarios. All right. Remember we said a budget is just a picture or an expectation for a certain period of time. And remember the budget can change. Right. So when you do a budget, whenever you budget, you have to assume certain things. Okay, you assume. You're going to say, well, okay, this month I'm going to spend X amount on fuel as part of the business. Right. If the fuel price changes, the budget could go up or the budget could go down, and we could over budget or under budget depending on the situation. Happy with that concept?
Yes.
Okay. Do you want your income to be more than or less than what you had budgeted? What's ideal?
Less.
Your income.
Sorry, more. I want it to be more.
Of course, you'd want your income to be more than what you had initially budgeted.
Yes.
Okay, remember your initial budget is your expectation. The results is the actual like the actual amounts. Okay, actual versus budgeted. All right, that's also something maybe I should add here, actual versus budgets. Right, they have asked you to compare things in the past, like is the business doing well or not, and then sometimes they've given like previous like amount, and then they've asked you to compare to indicate whether this was good or bad. Okay, and then the last question, do you want your expenses to be more than what you had budgeted or less than what you had budgeted?
To be less than what I budgeted.
Good, yeah. So you always want your expenses to be less than the budget. If it's in line with the budget, that's fine. If it's more than the budget, there's a problem. Okay, we're going to have to manage money a bit better. Okay, and then just one last slide here. Just look at accounting. Accounting, this is pro forma. Okay, so accountants can also budget, but they don't call it budgeting. They call it pro forma financial statements. Pro forma meaning it's ahead of time. Okay, remember, accountants look at the past, they don't look at the future. Financial managers look at the future. They look at now and they look at the future. What decisions are we going to make today that's going to help us or harm us in the future? Okay, so when we're looking at accounting, accounting is purely that. Okay, what happened in the past? We're accounting. See the word account? I'm checking, I'm managing, I'm recording what has happened. Okay, what has happened is the past. That's not going to help us going forward. We need to know where we've come so we can know where we're going to go, and that's why you need accounting records. Okay, so when they're asking you about anything pro forma or budgeting related, they're going to give you information that relates to something, either now or the past, and then you are going to have to change it going forward. Okay, and those are the type of questions you'll get. Okay, it is quite complex, and obviously if we were looking at more practical questions, you could have a look at this. There's a reference in your textbook. I think I need to update the page number as well here for the new textbook. Let me just find it. Yeah, pro forma statements is on page 124. The judgmental approach is something that they described on page 128. Okay, let me just update that page number. Okay. Are we all right? Still on track? Still with me?
Yes.
Okay. I think I'm going to leave the difficult one for next time. I don't want to rush through the cash conversion cycle. The reason being is because they've tested this a lot. Okay, so the last few chapters are theory, so we won't struggle to get through those. I'm just worried about time this week. So I'm not going to rush through study unit 4. We can start fresh next time, and we can look at study unit 4 because it's a difficult section for tests and exams. Okay, so I'm just going to spend the last few minutes running through this last study unit 3, which is looking at working capital and current assets. Sound good?
Okay. Yes.
Okay, great. All right, so just to wrap up this week's session, we're looking at learning outcomes that highlight the management of working capital. Okay, earlier we spoke about what working capital is. Can you give us a quick summary? What is working capital? Quick answer. What is working capital? Working capital is?
Your assets.
Yes, which ones?
That you use.
Yes, which are?
Current assets.
Yes, short-term, current assets. Good.
Yes.
And?
Liabilities.
Yes, okay.
Current liabilities.
Yes, so this whole chapter is looking at the comparison between our assets and our liabilities. Okay, we need to understand what the difference is because that's going to give us the net working capital. Right, if I'm a financial manager, I need to manage the changes in net working capital. Okay, you actually spoke about this at the beginning where you looked at your from FIN3701, you spoke about the changes in net working capital. And that's exactly what you're looking at here, but you're just looking at the detail. Okay, you're analyzing it. When you're looking at FIN3701, if you go back to that module, you'll notice they never ever asked you to work this out. They always gave it to you. They gave it to you as, okay, the change in working capital is, and then they gave you the amount. It was either a plus or a minus, whatever it was, and then you plugged it into your calculation. All right, in this module, we're going to calculate it. That's all. That's the only difference. All right, so I'm glad that you've done this module because you have some context. All right, we're literally going to take what you know there, and you're just going to do the working here. So the two link together. All right, it's the same textbook. They prescribe the same textbook in FIN3701 because it's the same concept, but two different perspectives. Here we're looking at short term, there we're looking at long term. All right, and then just to start off, we've got some general discussion questions. The first one is, what do companies need to operate efficiently? What would you say? What's important?
I think good budgeting or planning.
Okay, that's not going to help operate. Operating means the doing. So what are we going to do to operate more efficiently? If I was looking at goals and like long term and like trying to achieve something, then planning will help with that. Planning is not really going to help you with operating. It can. I'm not going to disagree with that, but that's more like management related. If we're talking financial management, if we're talking net working capital, what do companies need to operate efficiently?
I think to manage their liabilities, their current liabilities.
Okay, so that's good. So meeting obligations, that's good. Okay, so the obligations will be with who? The creditors. Okay, that's a good
Yes.
point. What else? Think about operating. What else do you use to operate?
Your assets, current
Yes,
assets.
which ones? Be more specific.
Current assets.
Which ones? Which ones do you use that are used constantly when you're operating?
Inventories.
Nice, that's a good one. What else? Inventory is sold to who?
To debtors.
Yes, there we go. Okay, right. So you've covered them. When a company is operating, right, they need to manage these key components, and you will see it in the cash conversion cycle. All right. When we start next week, we'll look at that. That's an important section. It always comes up. It's a nice section because it's looking at all the different components: creditors, inventory, debtors, and the most obvious one, the C, the cash. Okay, it's the cash conversion cycle. Right, the concept of liquidity you spoke about earlier, it's the ability to pay or meet operating requirements. Okay, can I sell that inventory quick enough so I can continue operating? Can I collect debtors quick enough so I can continue operating? Do I have enough money available to pay my creditors quick enough so they don't charge me interest or penalties or fees? Right, so liquidity, you mentioned it earlier. I know you know what it means, just to highlight that, because in this section, it's about this, working capital. Right, and then the last bit, in financial planning, should managers monitor cash flows?
Yes.
Definitely. Why?
Well, because it gives you an idea of the future, of what you need to do.
Yes. Okay. Remember, it's working capital. Okay. So what cash flows are important? It's those that we look at on a day-to-day basis. Okay. So let me ask you this quick question. Are you worried about money that you're going to have to get when you're, I don't know, 50 years old or 60 years old? Do you worry about that?
Yes.
But not as much as like
As now,
as the
more.
current situation. Yes, because remember,
Yes.
you need to manage the current situation. If you manage the operations correctly, you will automatically have sufficient capital in the future. So a business, they're not going to focus on like 50 years from now or 10 years from now. The business is going to focus on now, and they're going to focus on the next few months. And they're going to focus on operations. Do we have enough money to pay for the generator to keep the lights on? do we have enough money to buy enough stock to continue operating? Right. If they do all of that correctly, they will have more money in 10 years, 20 years, 30 years, 40 years, 50 years. That will take care of itself. Okay, maybe you've heard this concept. How do you like consume an elephant, right?
Right.
Like piece by piece, right? Like it's
Yes.
a large like problem situation, whatever it is. You've got to break it down into the operational things or the day to day,
Yeah.
right? Does that make sense? Are you with me?
Yeah.
Okay,
Yes.
you can't focus on the future if you're not getting the day-to-day right. If a business is bleeding money and their net working capital isn't being managed, I don't care how optimistic that business is, they're not going to have money in 10 years, 20 years, 30 years, 40 years if they have problems
Yes.
with the day-to-day. Fix the day-to-day, manage your operations, get your money right now, and then you will have more money in the business in the future. Make sense?
Yes.
Okay, that's what we're looking at here when we're looking at net working capital. Okay, these are the fundamental principles that we need to understand when businesses make decisions. Make sense?
Yes.
Okay, let's do some analyzing of these different categories. You helped me a lot actually earlier, so I'm just going to reveal them. Current assets, you spoke about inventory, you spoke about debtors or accounts receivable. The other one, the one that we need to highlight is this one, cash and cash equivalents. Okay, those two are important because they are liquid. Inventory isn't as liquid as cash and cash equivalents. Cash equivalents could be something like a deposit, a savings account, something that's similar to cash, that's easily accessible. Inventory is not very liquid. Okay, accounts receivable, debtors also, it's not very liquid. Okay, those are problems. Okay, they're asterisks. We need to manage them a bit better. Current liabilities, we spoke about them. Just to add to the list, this is the important one. You will do workings and calculations on this. You also get some time value of money calculations towards the end of this course where they ask you to measure different types of credit. Okay, they give you like term loans, they give you bonds, they give you all sorts of different financial instruments, and your job is to work out time value of money, to calculate the interest rate, etc., to determine the cost of those loans, to make sure that you can manage that credit. And then obviously current liabilities, the bank overdraft, that's the obvious one. That's just looking at debt from the bank, where they give you some of their money so that you can continue operating. All right, so from an exam point of view, inventory, important. Debtors, important. And creditors, important. And then some short questions on interest calculations and loans. All right.
Okay.
Just a note here, obligations. From an accounting point of view, you know that's a liability, hey?
Yes.
A liability is a present obligation. Right, so if companies don't or can't ensure that their obligations are met, what's going to happen to those businesses?
They're not going to survive.
Exactly. They're going to fail. They're going to, inverted commas, die, like you said. Okay. If we can survive, the business will continue operating. So survival in a financial management context is this, the net working capital. Which one must be bigger? Which one must be bigger?
Current assets.
Yes. Okay, you always want this to be greater than that. Okay. Happy with that slide?
Yes.
Okay. Just a bit more theory. If I'm looking at current assets, we just said, like literally a second ago, we said current assets need to be greater than current liabilities. So what conclusions can we make? Like what can we take away from that discussion if we know this needs to be present? Give me some ideas.
Well, you're going in the right direction because that means that your business is
Okay, not quite. Be more specific. Talk to me about debtors. Talk to me about inventory. Talk to me about
your debtors and your inventory is obviously higher than your creditors.
Okay, that's fine. But remember, we're looking at conclusions. So Forget about the link. Don't worry about debtors affecting creditors or creditors affecting debtors. Just tell me about debtors. What must we do with our debtors to make sure that we have this?
Oh, we need to follow up and make sure that money's being paid on time,
Perfect.
collecting. Yeah.
That's the right answer. Okay, so with debtors, you want this to be sooner rather than later. So next week, when we do the cash conversion cycle, CCC, and we do the average collection period, okay, I'm just using ACP. Remember I said earlier, you need to know ratios from your previous modules. ACP, average collection period. This is from your FIN3701 and FIN2601. Okay, that average collection period, do you want that period to be longer or shorter?
Shorter.
Exactly. Okay, remember this for next week because we're going to dive into those workings and calculations. Triple C will always come up. And they might even give you theory questions relating to it. They might say, well, calculate triple C, calculate ACP, work out AAI. AAI is the average age of inventory. Okay, if I'm looking at the average age of inventory, do I want to have that inventory for a longer period of time or a shorter period of time?
A shorter period of
Good.
time.
Okay, so sell quicker. Okay, keep stock for less time. Okay, so your average age of inventory, you want the age of the inventory to be shorter. Okay, quicker. Right, and then creditors, the last one. Creditors is APP, average payment period. Talk to me about that one.
Well, I think you'd want a longer
Good.
payment period.
Yes, longer period, pay as late as possible, but without incurring additional
Costs.
Okay, you don't want to, so if someone gives you 30 days to pay them on day 29. If someone gives you 60 days to pay them on day 59. Please don't pay them late, because if you do, you're going to get charged interest, you're going to get charged fees and penalties, and that's going to make the working capital even worse. All right, so that's very important. When you're looking at these conclusions will help you to answer a theory question in your exam. Make sure you remember this, and then make sure each of the different components you can address the concept that's being described. Okay, collect sooner, pay later, sell stock quicker. That's all you really need to make sure the business will run forever and ever and ever. Okay. All right, here's the notes about current assets less than. That's the bad part. Okay, so talk to me about this. Give me some conclusions. If it's the opposite, what would you say?
Then we're in trouble, because we need to try and decrease the current liabilities.
Okay, so your debtors, are you collecting too soon or too late?
Too late.
Good. Tell me about the inventory.
We have them on hand for too long.
Good. Tell me about the creditors.
It's either costing us money,
Yes.
maybe we're taking too long to pay.
Good. Yeah, or you have too many creditors and you're not paying them
Yeah.
off. Yeah, 100%. Nice. Right, it's basically the opposite of what we described there. Make sense?
Yes.
Okay. If you manage this, if you have more assets and liabilities, you end up with that. Good working capital. If you have bad assets compared to liabilities, you end up like that. Okay, so just be careful. You need to remember the basic principle. Right, and then we've got the 4 statements. Your accounting. Can you list them all 4? Can you list all 4 of them for us?
I think so.
Try. Go for it. What are the 4 financial statements?
Statement of profit and loss.
Good.
Other
Yes.
comprehensive income.
Yes, 100%.
Financial position.
Good.
Statement of financial position. Trial balance.
No, trial balance is not a financial statement.
Okay.
You use the trial balance to create the financial statements. Okay, so you've got the profit and loss one, you've got the financial position one.
Statement of comprehensive income. Did I
That's
say
the
that?
same as the profit and loss. What about the one that belongs to the owner?
Statement of changes in equity.
There we go. And then the whole session today, we spoke about how important cash is. So what's the last statement?
Okay, statement of cash flows.
Exactly. There you go. You've got all four of them. All right. Just remember, when you're looking at the statements, okay, you need to understand the working capital. Okay, in other words, the structure, right? So which statement gives us the structure? Which statement tells us about their structure, how much debt and equity they have?
The statement of changes in equity.
No, that looks at the capital, the reserves, the profit and loss. Okay, which one looks at the
Statement of
structure?
cash flows.
No, cash flows is looking at money going in and going out. The structure.
Financial position.
Yes. Okay, remember this. A equals OE plus L. Isn't that
Yes.
what the statement shows? Don't you have a section called assets and then a section called equity and liabilities?
Yeah.
Okay, when a business is operating, what does a business do? Okay, they raise capital either through their own money, so they save up enough and then they buy an asset, or they take out a loan to buy the asset. So assets can be acquired either using debt or equity. Make sense? That's capital
Yes.
structure. That's FIN3701 basically.
Yes.
Right, how does it help us in FIN3702? Well, on the next page, okay, we're talking about this, the short-term financial management considerations. Okay, the firm's capital structure doesn't only look at long-term, it also looks at short-term. Okay, so when we're looking at the short-term requirements of the business, we need to make sure that we're managing all of these considerations. Okay, inventory, you want to sell stock quicker. Debtors, you want to collect sooner. You want lots of cash on hand. You want lots of short-term investments. Okay, trade and other payables, you want creditors that can help you, but you want to make sure that they give you longer terms. Pay later. Right, which would be better? A supplier that gives you 30 days to pay, or a supplier that gives you 90 days to pay?
90 days.
Exactly.
Okay.
Right, and this is what you need to manage when you're looking at short-term financial management. Okay, you will see these accruals in a separate chapter. You will see the short-term borrowing also in a separate chapter. Right, every chapter from next week onwards is going to look at all of these different considerations. The triple C, the cash conversion cycle, is a combination of four of them: inventory, debtors, cash, and creditors. Those are the four. Right, and then the other ones are described separately. Right, and this is almost like an introduction. You will see this next week as well when we're looking at the cash conversion cycle. Just remember, we spoke about this earlier. This is just the diagram for it. Okay, remember, what is the primary goal of a business? We spoke about it earlier. Primary goal is?
Your short-term obligations.
No. The goal of the firm, the goal of the company.
Oh, firm value.
Yes, value.
Increasing value.
Yeah, value or wealth. Good. Okay. If a company is going to be running its business, all right, remember cash has value, but how do you increase the value of cash? You can't. You have to use it. All right? Cash can be used to pay your creditors. The creditors will provide us with finance. So do we need money to start the business?
Yes.
No, we don't. Okay, we don't need any money. We just need a creditor. Somebody that's going to give us stock. Do you agree?
Okay, yes.
So this diagram summarizes the cash conversion cycle. Okay, next week we'll do all the workings for each of the different components. This week, okay, towards the end of chapter or study unit 3, we're looking at this concept, net working capital. Right, net working capital means we need to manage cash. A cycle exists as cash changes or transforms into something else, back into cash. Right, so let's just delete this bit here. Let's assume we don't have any money. We have nothing, zero. But you have a supplier, and that supplier has lots of surplus goods. Okay, they've got goods that they can't sell. Do you think you could convince them to give you some of the goods today with the promise to pay in the future?
Yes.
You could. And there's your financing. Right, creditors is a form of finance. Right, so I had zero money, but I managed to get my hands on 100 Rand worth of stock. Okay? And that stock could be anything. Okay, let's just assume it's raw material. Right, it's raw materials, you can use that, you can make something with it. That 100 Rand is now going to be sold to a debtor at a profit, 200. Okay, hopefully we've managed the debtors correctly. We'll look at that next time, 2 weeks time actually. We'll look at debtors. Okay, we'll look at managing them. Assuming you've managed them, assuming you've got good debtors, you should get paid, right? So now we've got 200 Rand. Okay. Have we got working capital in this business?
Yes.
Yes. Okay, what happened? We started with nothing. Okay. We created 200 Rand of inflow. Money coming in, plus 200. Okay.
Yes.
How much do we need to pay the creditor?
100 Rand.
Yes. Well, it's probably going to be a bit more than that, maybe 110, because there might be interest. Let's assume they're a
Yes.
nice creditor and they don't charge us interest, and we pay them within the 30 days, then we're only going to pay them the 100. So that's fine. And that'll be the out. Okay, so what are we looking at? There's the amount going out, there's the amount coming in. Okay, the difference is the net working capital, right? And this business is now generating cash. Okay, that's why we have a cash conversion cycle. Cash will be converted into inventory. Inventory will be used to sell. The sales will be collected, and then that cash will be used to pay off your suppliers. All right, do you see how the cycle works?
Yes.
Right, it's basically how money is circulated or in circulation in the actual business. Right, a business is all about that. Taking money, doing something with it, making it money again, making or doing it again and again and again and again and again. Okay, the cycle will continue. Right, and if the cash conversion cycle is short, then money is going to come in quickly, and then you're going to continue to increase the reserves of money in the business. The wealth and the value in the business is going to increase, all because you can generate your own cash. All right, so it's not about getting money from outside providers. Okay, that's what we covered in FIN 3701. FIN 3701, you weren't looking at operations. Okay, in FIN 3702, everything we do here is operational. We're looking at how can a business make its own money rather than have to go find it from external financiers. Make sense?
Yes.
Okay, that's a very important concept. Keep that in mind for the next time I speak to you. Okay. All right, this I'm going to give you as an exercise. I want to see what diagram you can put together. Maybe use your own example. There is one in the textbook as well. That's up to you. But let's discuss this next time. I'm going to give this to you as a bit of like a / homework type situation.
Okay.
Try draw a little diagram outlining the different stages, but try cover it in as much detail as possible. In other words, like put the little write a little note, draw a little diagram. If you want to, you can use this diagram as your guide. Okay, you can use this as a starting point.
Okay.
Okay, but literally on this diagram, you can use the diagram under cash, write down or put as many points as possible that speak to that aspect of the diagram. Same thing for creditors, same thing for inventory, same thing for debtors. Okay, as I said, you will see all of this after the CCC, the cash conversion cycle, because the textbook is going to now zoom in and magnify each of these key considerations. Okay, so this week we've covered the high level. We're looking at why we have to do what we're doing here, and we're looking at all the reasons why this will help the business. Next week, we need to look at all the detailed calculations. Okay, each of these will have a calculation that we need to do. All right, think you can manage that?
Yes.
Awesome. Okay, so let's just leave that blank. And then there's one more slide here, just highlighting that difference, or not difference, that relationship between profitability and risk. Okay, how can firms increase their profits? Do you know? I'll give you a clue. They're going to increase risk, or they're going to add risk.
By taking less risk?
No. They need to take more risk if they want to increase their profits. Okay, no risk, no reward, right? So if we're looking at profitability, there's a trade-off. So when a firm increases their profits, they're adding more risk by doing what? Come, think about it. If you're running a business, how can you increase your profits?
By taking more risk.
Be more specific, how? How are we going to add more risk? What are we going to do?
I don't know.
Offer credits.
Okay.
Sell goods to customers. Give them goods without receiving cash. Is that risky?
Yes.
Of course that's risky. Okay, who's going to give goods or services to a business or a customer and not get any cash for it? That's very, very risky. Is that going to increase their profit? Will you record a sale?
Yes, you'll record a
Yes, you
sale.
would, but you're not going to manage your net working capital.
Yeah.
Do you see the difference?
Yes.
Right, and this is something that is covered when you look at the debtors. Okay, adding debtors or offering credit. Offering credit is risky. Very, very, very risky. I don't know if you've ever given anyone credit, maybe a friend or a family member or a stranger, or you've sold something on credit. Offering credit, have you done it? Is it a
No.
okay? Or maybe your company, the company you work for, do they do it?
Yes.
Okay, what happens when you give out credit? It opens a whole world in terms of problems potentially.
Yes.
Bad debt,
Yeah.
communication, debt collection, etc., etc., etc. That's risky, but it also increases your profitability. The important thing is you need to manage the credits. Okay, there's nothing wrong with giving credit, but then just make sure you choose who you give the credit to. Okay, you're not going to give everybody credit. You're going to give certain individuals credits. Right, those customers that want credit, they need to prove that they can have it. Right, that's something that they need to consider. All right, so that's the trade-off. Okay, when we're looking at profit versus risk, companies always want to maximize their wealth or their value, but they need to think, what is that going to do to their business? All right, and you've got a nice example. I'm going to put a little note here. See later. Okay, the credit policy example. Okay, in one of the examples in your textbook, they ask you to adjust the credit policy, and it literally, it explains all of the obvious points. Okay, increasing your credit, in other words, giving more of it out, is going to lead to potentially more bad debt, but also an increase in profit, increase in sales. Right, just remember, firms that are technically insolvent are firms that don't have any resources and they cannot pay their bills. Right, technically means you can't. Technically meaning you need help, you need assistance. Okay, if you can't pay your bills, you're technically insolvent. Okay, if you're spending more than you're earning, there's a big, big problem. Okay, and that's what companies need to manage. Right, net working capital is making sure we can always meet our short-term obligations so that we're never, ever, ever, inverted commas, technically insolvent. Right, how do we do that? Make sure you have good cash flow. Right, so which cash flow is, I think I put a note here. Yeah, let me reveal. cash flow that's nearer is less risky. Why is it less risky? Can you explain that for me? Cash
Well,
flow.
because you have it,
Exactly.
so you know that it's not something you have to wait for or
Yes. Okay. And also think about time value of money, TVM. Would you rather
yeah.
have money today or would you rather wait for it tomorrow?
Today it's worth
Exactly.
more.
Exactly. So cash flow nearer is better. Right? You don't want to wait too long. If you have it now, that's better. But when you have to wait for something, then you're looking at the time value of money because now all of those um, time value of money principles need to apply. Right? And that's why when you look at current assets and liabilities, okay, consider that because there is always going to be a cost. Right? There could be an opportunity cost, and that's going to affect the risk. Right? The risk will either be higher or lower depending on what the business is doing. Okay.
Okay.
Happy with this week's content, the
Yes.
first 3 modules. Okay, yeah, I don't want to look at this one. You've got all the notes, so if you want to, maybe I would advise maybe doing a little bit of like pre-reading or just going through some of the content. So at least
Okay.
when we start next time with some of the content, you might even have a few questions relating to the topic. All right, but yeah,
Okay.
sorry I went a bit over, but at least we've covered what we needed to do. We've set the picture. The picture has been set. Next time, I'm going to focus a lot on the calculations. Okay, this is a very, very popular exam question. You will always see it in your exams, CCC, cash conversion cycle. All right, Parosha,
Okay. Okay. Thank you
happy.
very much.
You're very welcome. Thank you for attending, and I'm gonna send you access to the video as well, and then you can review anything if you need to. And then what I'll do this week is I'll put together that exam pack and then send it to you, so at least you can start maybe working through some of it. And then next week we'll continue with the rest. We'll wrap up the last few slides, and then I'll take questions, and we can do some as well if there's time. Okay.
Okay. Thank you very
Awesome.
much,
All
Anthony.
right, Prosha. Enjoy your weekend.
You too.
Okay,
Bye
bye.
bye.